Hi, this is Mike Rankin with Relational Intelligence, and here today to talk about health savings accounts, or HSAs. You've probably heard of them, but you may not know all of the details, and we think it's one of the most important financial tools at your disposal. And a health savings account, we like to think of it as like a medical 401k plan or a medical IRA, individual retirement account, because it combines the benefits of both of those things. And sometimes when people hear HSA, they think of another benefit called a flexible spending account, or FSA, that has this use it or lose it thing, which doesn't apply to HSA. So money rolls over year in and year out. And it's right in the name, right? So HSA, the S is for savings. And so the basics on an HSA, health savings account, it's like a medical 401k plan. You use it to pay for your medical expenses in a tax-advantaged way. And you have to be enrolled on a high deductible health plan. And that's sometimes where people get a little tripped up, but we'll talk about that in a second. And the money rolls over year in and year out. No use it or lose it provision. In our view, think of the medical of the HSA, again, like a medical 401k plan where you can make the contributions. And if you can contribute up to the maximum, that's strongly what we recommend. So budgeting is really, really important. And almost anybody that comes to us for financial coaching, we start with budgeting. I know it's boring and a little bit painful, but that's really where everything flows from. And so to the extent that we have the ability to put the money in the HSA, that's strongly what we recommend. And the HSA is actually split up into two accounts if you want it structured that way. One is the bank account and the other is an investment account. We like to keep 2 years worth of your plan deductible, your high deductible health plan, keep 2 years of that in your HSA bank account, and then take the rest and roll it over into an investment. And this certainly can be a new concept. It's a new concept for a lot of people, and it feels a little scary, a little intimidating to make that leap into that high deductible health plan, because you do have that deductible up front. So again, going back to the budgeting and the basics of financial planning, it's really important to have a rainy day fund for medical. And that's something that used to be common wisdom, is to have this rainy day fund for medical expenses. But I feel like we've kind of gotten away from that in the last 5, 10, 15 years. So really something important to kind of build up. But if you do that, and you might say, okay, well, Mike, that sounds a little scary. Why do I do it? And if you think of yourself today and then your future self down the road, 20 years from now, 30 years from now, I know it's a long way in the distance, but life, God willing, is a long race. So the HSA is really about asset accumulation and being able to build up more money over time. And we believe that through the HSA, you're going to have more healthcare security than with any other tool out there. So the tax benefits, in most states, you put the money in tax-free, and it's also federal tax-free on the contribution. There are 2 states currently, California and New Jersey, where you have to pay the state income tax. But otherwise, it's federal income tax-free for sure, and then depending on the state where you live, it may or may not be state income tax-free. But you can put in up to the limits here, roughly $4,000, a little over $4,000 for an individual, $8,000 for a family. That's the max that you can put in, but remember that rolls over year in and year out. So once you have enough money in your HSA where you can start putting money into an investment account still under the HSA, self-directed investments, you can let that money grow over the long term. And why would you do that? Well, when you get to retirement, you're able to use your HSA funds, again, tax-free, for Medicare payments for Part B and Part D. And many of us think, oh, Medicare is a government program, there's no cost to it. That's not true. Medicare can be quite expensive. So it will cost you money in retirement to pay for your healthcare expenses, long-term care expenses, and so forth. So that's the reason that we would go through this effort and energy and the savings to have that money tax-free down the road. But it is a very, very powerful financial tool that we try to educate everyone as best we can. So the next steps would be at your next open enrollment, certainly evaluate the plan options, talk to your advisors, determine the tax impact for you based on where you live, and then look at, obviously, any investments may have potential gain and loss that are associated with that, so you need to evaluate your risk appetite as well as your investment horizon. But Certainly investigate the HSA, understand what the benefits and the long-term opportunities are, and if you have any questions, please let us know.